This week on the Retirement Quick Tips podcast, I'm recapping the stock market, the bond market, the economic climate of 2024, and looking ahead to 2025. So today I want to tie everything together and talk about some opportunities that exist for 2025. And I think a lot of the themes that were present in 2024 that were driving the markets and the economy are likely to continue. So we had a strong economy. Now, it wasn't like robustly growing, but it was growing. And I think that that will continue into 2025. We had a fairly stable employment rate, and the unemployment rate was ticking up, but in general, it's still pretty low, especially when you look historical norms. So employment is really stable. You have declining interest rates. The Fed cut rates a few times in 2024. They're expected to cut rates a couple times. So they're expected to slow that in 2025. And then we had profit growth among corporate, especially the large, like publicly traded stocks last year. Now, looking ahead into 2025, I think there are a few themes that should drive certain investment decisions on a pretty broad level. So I do think that the gains in markets will continue. I think that's true for the stock market, but I also think that that's true for the bond market. Because in general, if interest rates are in a period of either not moving much or pretty stable or unchanging, or if they're in a period of decline, like they are expected to be in 2025, the expectation is that interest rates will continue to go down in 2025. So if that theory holds true, then what you would expect from the stock market is that the Fed's not going to really influence the market that much. It's going to be other things. It's going to be policy. It's going to be taxes. It's going to be the economic growth situation, not so much the actions of the Fed, which have really influenced markets over the last several years. But because they're going to be quieter and not be so involved in cutting rates or even increasing rates, I think it's a pretty friendly environment overall for stocks and for bonds as well. So I see a couple of areas, specific areas of opportunity in 2025. One is I think that the large tech companies that have dominated the market performance over the last few years, I do think that they're getting a bit stretched. However, the excitement over AI, artificial intelligence, that's not going anywhere anytime soon. I think that the overall market, like S&P 500, a lot of the larger tech names are probably poised to continue to do well in 2025. But I also think that unlike the last few years, I would anticipate broader market gains. So not just the biggest tech stocks, but also I think I would expect small cap and mid cap stocks, smaller companies, not just the big boys, but the smaller ones as well, to do well in the year ahead because we have lower interest rates now and we have a friendly regulatory environment. If you think about a small business, higher interest rates can be absolutely crushing. A large multinational, one of the largest companies in the world, think about those people. Yes, they struggle too when interest rates are higher or when regulation is higher. But it's the little guys that struggle the most. And so in a lower interest rate environment and also a friendly regulatory environment that we anticipate into next year, I would expect growth broadly across not just small cap, but large cap value. I think stock markets pretty broadly, I would expect gains, not all the way across the board, because you're still going to have certain pockets of the economy, especially if the tariffs and the rhetoric, if that becomes reality in some type of policy. What's likely, and I talked about this around the election, broad-based tariffs that are going to spike inflation significantly, I think that's pretty unlikely. What's more likely is that you have tariffs on specific types of products coming into the United States. And so there will be specific maybe pockets of the economy or certain industries that are negatively impacted by tariffs. But I don't think that the reach of that and the impact of that is going to be broad-based across the economy. So in general, I think that stocks across all different sectors, sizes are actually poised to have some growth. Probably not as strong as what we've seen in the last couple of years, just because that's been an anomaly, but certainly stronger. So I would emphasize diversification, making sure you're not too concentrated in certain areas. I would also tilt, especially on the stock and bond side, more towards the US. There's a lot of geopolitical uncertainty and issues between various wars around the world. There's a lot of demographic issues. I've talked about this already, but as far as areas to focus on and areas to avoid, I'm more US centric now than I have been in pretty much all the last 17 years. I think you can make a strong case for, you don't want to have all your eggs in the US basket, certainly not. But I think a lower percentage in international and a higher percentage in US will help to protect and preserve more growth, because I think there's so many economies and regions around the world that are just struggling, and it doesn't seem like that's going to turn around in a robust way anytime soon. As for bonds, one of my favorite strategies, and this is a perennial favorite strategy, but it's also an interesting opportunity looking ahead into 2025 with the current interest rate environment, and that is a bond ladder. So if you're not familiar with a bond ladder, there's a number of ways you could construct a bond ladder, but I'll just use a popular example of a 5 or even a 7-year ladder, but we'll just use a 5-year ladder. Picture a ladder. So each rung on the ladder is 1 year. And so you have a bond that will mature next year, then the year after that, and so on, going out 5 years. What's attractive about this bond ladder strategy, particularly in the interest rate environment that we're in, is that rates are relatively high compared to where they've been the last 20 plus years. So if you were to construct a bond ladder today, you would be buying bonds at rates and locking in interest rates for the next 5 years at some of the best interest rates that we've seen over the last couple of decades. So right there, it's a very good strategy. Now, what I like, if you fast forward a year, those bonds are still locked in, except for the first one that's going to mature. So if you think about the 5-year bond ladder, only 20% of the portfolio is maturing every year. The rest, the remaining 80%, is still locked in at the rates that you purchased the bond ladder at. And given the likelihood that rates will be either pretty flat or in a period of decline, now is an excellent time to be locking in rates that you could enjoy and provide stable income for the next 1 to 5 years. Now, you could go out further than that if you want to. I think that going out much further than 5 years, I don't see a lot of upside. I see more downside because rates could reverse and interest rates could start going up again at some point. And the longer it is between now and when your bonds mature, the more you're going to see price declines in your bond portfolio, the further out you go. A bond ladder is not the only way. I like it because I think it provides stable income. And again, it's a great time to lock in rates, but you don't want to buy like a bunch of 10-year bonds where you have to sit on them for 10 years. It's nice to have bonds maturing and have the opportunity to cash out and reinvest every year. But again, only a small minority of the portfolio is maturing every year. And that's the beauty of constructing a bond ladder in a pretty high relative to history, at least recent history, interest rate environment. Now, as far as which bonds you would pick, there's a lot of different choices you have. A lot of it comes down to individual preferences, your risk tolerance, your tax situation, the type of accounts that you're buying. But you can buy individual bonds, you could buy CDs, you could buy corporate bonds, municipal bonds. Those are tax-free municipal bonds. If you are in a high tax bracket, you're investing in bonds in a taxable, like a non-IRA taxable account, I would seriously look at tax-free municipal bonds. So there's all kinds of different ways to invest in a bond ladder. You can even purchase single year maturity exchange traded funds or ETFs. So you don't need to buy individual bonds. You can build a whole portfolio of hundreds of bonds with like $100. There's so many ways to build a bond ladder. And again, it comes down to your individual situation. But broadly, I think it's a great strategy, especially in this environment. Okay, the last thing I want to touch on for opportunities this year is cash and money markets. Now, it's always wise to maintain a cash cushion, liquid savings at the bank that's accessible for emergencies. But if you pay attention to your bank account statement, you're probably earning 12 cents a month, if that, on your interest, which is just highway robbery. How dare they? Oh, the banks, they're so easy to pick on. But anyways, so I wouldn't keep excessive amounts of money parked in just a savings account or a checking account that isn't earning any interest. You could lock it up into a CD or 3-6 months even, earn a little bit of interest, especially if it's unlikely that you'll need the funds. So I would be vigilant about making sure that your cash is invested. If you're going to maintain cash beyond what you need for emergencies, I would look at shorter term CDs. I would look at high yield savings accounts where you can earn 3%, 4%, 4.5% in some cases. The same thing is true for money markets. The importance of cash in this current environment is that there's still a lot of uncertainty. The policies and inflation and geopolitical issues. And I've talked about how I'm optimistic for the economy, but there's no guarantee that that's going to happen. We always get curveballs. And so maintaining enough cash for not just emergencies, but especially if you're retired, you're living off of your portfolio income. It's very important to maintain cash reserves, and that includes money market or shorter term CDs. So you can draw from those accounts when you need money rather than sell your stock portfolio or even your bonds into the teeth of a downturn. We want to avoid that at all costs. Oh my goodness, I just looked at the time. What did I talk about for 13 minutes? Okay, the bottom line here is I don't have any rocket science ideas for 2025. I think if you take the long view, if you look at the current environment that we're in and you say, okay, I'm going to invest based on likely scenarios, not on possibilities. If you invest based on possibilities, you're just going to go out and buy bullets and canned food and I don't know, Bitcoin or gold or something. I don't know. Whatever it is that you buy when you're freaked out. So things could always turn south, but we want to be reasonable about that. And we want to take the long view and maintaining diversification, broadly investing, reallocating where appropriate, being smart about how you take advantage of the current environment that you're in with interest rates and the economy and where things are at. That's kind of boring advice. I get it. But it's also correcto over the long term. And so we don't want to lose sight of following the basics and getting those right. And then on the margins, if you want to invest in some mad money here or there, go for it. But set up your portfolio so that it's poised to do well if the trend continues. Or you also have some protection on the downside from cash and some fixed income and good quality stocks so that if things do go south, that you have some protections in place as well. All right, that's it for today. Thank you so much for listening. My name is Ashley Michike, and this is the Retirement Quick Tips Podcast.